At the moment of compelling interest are the macros. GDP numbers came on Friday, and RBI is going to decide on rates tomorrow. Let's invite Jahangir Aziz, the chief economist of JPMorgan. In a bit, we'll also be joined by a dealer from Citibank. Good morning, Jahangir. Thank you very much for joining us. What's the spin on what the governor might do? There is a compelling feeling with global commodity prices moving south. The pressure on domestic inflation is only going to recede next year. So why should he wait? What's your sense?
Look, I think that clearly is a big event. In fact, the $25–30 per barrel reduction in oil is probably the biggest event as far as inflation, disinflationary pressures globally and growth is concerned in India. What we haven't really seen so far is a sense that is actually translated into other variables, to higher purchasing power, consumers reacting to that, better corporate margins and corporates reacting to that. So we haven't really seen that. Only thing we have actually seen is the tumbling in inflation. But even if you look at that, I think much of the decline in inflation has come from the decline in food inflation more than that in crude oil prices, and because I think growth has been slow. So I think to say that because oil is probably going to average around $80 a barrel in 2015, therefore the battle against inflation is over, and therefore the 6% January 2016 target is now assured, that I think is a bit too premature.
Okay. So when are you expecting the first rate cut?
My guess is that, look, you could say tomorrow the RBI relenting and giving us, a 25 basis point oil rate cut. But my guess is that the RBI is probably going to wait. It's going to wait for two reasons. One is that there is a base effect on the other direction coming into play in the months of December, January and February. They would like to see how big or how bad that is. They would also like to see where exactly does oil price flow. We do expect oil price to continue to fall in the first quarter of 2015. Then there is the budget. Does the government manage to meet its 4.1% target? And what is the budget for the next year? What are the reforms that will happen in the winter session of Parliament? And more importantly, I think this is where the critical problem is the decline in food inflation structural? Or is this something again cyclical, and we'll again be very rudely surprised back in January, February and March? I think the RBI will want to wait, see all of those events actually unfold, where things stand. And my sense therefore is that in April is when they actually do their first rate cut, but the rate cut is unlikely to be just 25 basis points. It will probably go with a very decisive 50 basis points of rate cut.
All right. We have Bhanu Vohra, head of global market sales in Citi, South Asia, join in our studios as well. Bhanu, that question to you. What is your treasury going with tomorrow?
We have a consensus that we do not see a rate cut tomorrow. But having said that, clearly it's a very difficult task, right? Because there is merit in saying that there is time for us to watch inflation a little more before we put a finger on a rate cut. But one is an order. Whether it is post-March, post the budget immediately, it's difficult to say. But we would go with a 50 basis point cut towards the next year.
As Jahangir has been saying.
Yes.
Now, if that were to happen, how will the yields react tomorrow? If he doesn't cut, do you expect him to change his language in some fashion? In any case, what will you be prepared with in terms of bond movement tomorrow and thereafter?
See, bonds have rallied already. You see a number of 8.04 right now. Till the time a rate cut happens and till the time the repo remains where it is, I do not think that yields going below 8 is very much likely. So we would be positioned very square as far as tomorrow is concerned. But yes, there is clearly a move for yields to track downwards. We would put a number of 7.95 to 8 in the coming few weeks, but that's just about it till the time a rate cut happens. And we have far more clarity. The other thing we have to be very careful about is the Fed changing its stance on a very regular basis. We have to keep seeing very actively on when does really Fed start hiking. Now the consensus is more towards the year end than it was at the start of the year. So those two things would be important to track.
Okay. By the way, we must keep an eye out on what's happening with Brent because it continues to fall rapidly. In fact, as we speak, it slipped to 67.9, about a 3% fall. Remember, when we woke up this morning, it was trading at somewhere around $70 a barrel, and now it's 67.9. So considerable fall is what we're seeing in the last couple of hours itself. Jahangir, hi, morning. I wanted to ask you what your trajectory is as far as the GDP is concerned, because as we go forth, we might see the agri growth peter off because of the weak Kharif. We might also, see the government spending go down as the government reduces its expenditure to meet its targets. Do you think this 5.3% number can sustain? What is the expectation in Q3 and Q4?
Look, the 5.3% number surprised us on the upside. We were actually expecting something below 5. Exactly for the reasons that you described, that we did not expect government expenditure to be so strong, and we did not expect agriculture to be so strong given the fact that we still have a deficient monsoon. So chances are that in the third and the fourth quarter of the fiscal year, you will see payback both on the government expenditure front, which has to be tightened significantly to meet the 4.1% target, even though there has been a significant windfall from low oil prices. And agriculture, given the fact that there was a deficient monsoon, should also slow down. So we don't really see the trajectory moving up. I think critical in all of this, I think there are two things that it is very difficult at this point in time to ascertain. One is the fact that Indian corporates have really been not very convinced by what the government has done over the last 6 months. If you look at investment growth again turned negative in the last quarter. IP number is languishing. Credit growth is near all-time lows. So we don't really see very much coming out from the corporate sector. I think the one big uncertainty is that this very large increase in purchasing power by Indian households, what do they do with that? Do they save it or do they start spending it? If there is some spending out of that, i.e. that the Indian households start believing that this decline in oil prices is here to stay, my guess is that you might get some upward movement from or support from consumption, but it's really hard to see this trajectory move up in the near term.
Okay. No, just a follow-up to that. So even if the monetary cycle reverses, it starts to reverse now, do you think there will be any significant uptick to the private sector?
Look, there has been a significant increase in real interest rates. I mean, that is undoubtedly the case because mechanically inflation has fallen. But this decline in inflation is a good thing. It is not happening because core inflation is going up. It is going down because input prices are falling, which means that the corporate sector must be enjoying a much bigger margin today than it was 3 months back because of the low inflation. So what it is losing in terms of higher real interest rate, it is gaining significantly in terms of lower input prices. So it isn't exactly clear that the binding constraint to corporate investment is high real interest rate. I mean, people will point to that and say, look, interest rates are now in real terms 300 basis points higher than they were 6 months back. Yeah, but so is corporate margins because input prices have fallen significantly. So my guess is that, cutting down interest rates will help in the margin, will improve sentiments, will give a signal that the RBI is confident that inflation can come down to 6% in a year's time. But does it move the needle for the corporate sector? Very hard to say.
Okay. One thing is very clear. RBI is clearly confident on the current account front, which is why they've removed all quantitative restrictions on gold. Bhanu, how do you read it as a rupee dealer? And generally more, where is the rupee headed?
Rupee has remained sideways. As I remember saying a few months ago as well, we see that sideways move continuing. If you see rupee volatility, it's in lowest digits we've ever seen, right? So that sideways moves will continue. We do hold a view still that there is slightly negative rupee bias. So where do we put rupee? Probably 3 months or 1 year down from now. I think it would still remain sideways, probably in the 62 handle and so forth. There are 2 or 3 things that are pushing the rupee to where it is right now. One, as I said, is just lack of volatility. We see good bids and offers from nationalized banks at all levels, right? That's number one. Number two, look at all other regions. You look at even Singapore dollar now at close to 1.32. All other regions have depreciated. So it's very difficult for rupee to remain just where it is right now. So I think it will drift slightly higher going forward. Now, coming on to the gold thing, I think...
When you say higher, you mean towards 63?
Yes, yes. Now, the gold move is a very welcome thing, but I think it is not just to... it has a lot of other objectives to achieve. You know, we've seen a lot of news around how gold is coming into the country and so on and so forth. This is a perfect setting. You see crude where it is, and look at India's dependence on crude. So I think this move is not going to really impact rupee very, very negatively. We saw rupee opening at 62.16 today, 16.17 now as it's trailing right now. 20.23 was around the open. That is where it will stay. We don't believe much to happen at all in the coming few months.
Two very quick questions because I'm being asked to wind up. One, what happens if there indeed is a rate cut tomorrow? And two, a year down the line, where do you see the 10-year? I'm not interested in what the RBI is. Where do you see the 10-year year down the line?
As far as the rate cut is concerned tomorrow, if there is a rate cut, I do not think that the market entirely is positioned as such. I think 10 to 15 basis points, 10 to 15 basis points is already priced into the market because it is a fatal event. So I would see yields going down probably to 790 or 795, nothing more than that. As far as currency markets are concerned, I just told you that the sideways moves is what we'll think will continue. There is not much that is going to happen in the coming data events also. As far as 1 year is concerned, that's a tricky question to answer at this stage. We'll have to be very careful of where gold is, where oil is, and what is RBI stance is. The commentary is going to be very important on how dovish they are and what exactly do they think about inflation. If I were to take a guess, I would take a number of 785 or so.
1 year down the line, 785?
797.
That's it.
I do not. We do not.
There are people who are calling even 6.5, 18 months down the line.
No, we do not think.
Not even 7%.
That's a very aggressive move at this stage. As I said, a lot of data points need to be considered.
All right.
Because it is fast changing.
Fair enough. We'll leave it at that. Thank you very much, Bhanu, for joining in and dropping it into our studio. And thank you, Jahangir, as well, dropping it into our Singapore studios.